Going. So, no demand at market top. Markets, as we know, are constantly being traded. A sudden down move will lock many traders into poor positions as they wait and hope for a rally to get out with little or no loss. If after a reaction the market then starts to go up, then any old resistance level to the left will require effort to go up and through these old highs because they have to overcome the selling from these locked in traders. To approach an old high on low volume and narrow spreads indicates that the old highs are not going to be penetrated because there is no demand. A market will not rise when there is no professional interest to the upside. Okay. So, here is a chart of Apple. Okay. Now, one of the things that, again, we're going to teach you is you do not short a no demand bar when you see it in an uptrend. The problem when you see no demand bars like this, which I will explain shortly, is although they often, when they approach an old top, will cause a reversal, sometimes you will find that the market will go back up to that area that you shorted on and could even go through it on an upthrust bar and take your stop out. Now, I was trading with Tom yesterday, wasn't it? I think it was. I was busily doing the charts.
Oh, that's right, yeah.
Okay, now Tom sat there and he said, well, look, Gav, here's a trade set up right in front of you. So I said, what do we see here? And he said, there is a clear example, he said, of an upthrust at an old top to the left. He said, on very high volume. He said, the market will not go through that on that upthrust. That's designed to catch the breakout traders. And he said, if it goes back up there on no demand, which is like this bar here, he said you can almost guarantee that that's a short right there, even though it was against the trend. Now, I said to Tom, now I like to see evidence that the trend's changed. He said, but then you would have missed the down move. I said, well, that's just the way I trade. But, you know, 15, 20 minutes later, it came off about 4 points, didn't it, Tom? Yeah. It was spot on. Now, we want to teach you to find and see these areas of weakness so that you know that the market won't go back up through there. Because if it goes up a third time to these old tops, and you can see what happened. We have one here where it tried to break through, and one here. You then as a trader know the principle and can decide if you want to be aggressive and short it. Because I know Tom would have definitely encouraged me to take that short yesterday, and it would have been a good probability trade setup. So Tom, when we see no demand, now the key to this, and in fact let me ask Philip first, we see no demand all over the place on a chart, okay? Now let me just define what no demand is, okay? It's an up bar, okay? It's a bar that closes higher than the bar behind it. That's quite important. The spread should be narrow, okay? Nice narrow spread or range, just as we see on this bar here and on this bar here, okay? The volume should be or must be less than at least the previous two bars. The lower the volume, the better actually. If you get really low volume on a no demand bar, it's not going to go anywhere and it's highly likely to come off. And indeed here you can see on Apple, on the weekly chart here, it fell, it went back up, almost this very same setup. And look at the weekly volume on both of them. You can notice how low it is compared to all the other weeks. Now, if you can spot that and you're a VSA trader, you will know that there's something there that's not right. Now, Chris, you're right. Because it's gapped up like it is here, this is still a major sign of weakness. It's almost the opposite of the end of a rising market, which is weakness on high volume. We've now got serious weakness on low volume. And it's in the same, because it's at an old top, and this is the key to it, it's at this old level to the left, okay, which I've put this line across, that it was hit once, hit twice, 3 times before it collapsed. That is alerting you that there's serious weakness there. So Philip, no demand at the old tops here. We talked about the end of a rising market. It was very high volume, narrow spread. We've now got very low volume, narrow spread at this old area to the top. Do you short those, or what are you looking for when you see no demand at a market top?
Well, if you're seeing it gap up like that with a narrow spread, what that's telling you is that there's no professional interest in taking prices higher. There's no professional selling in there, and there's no interest by the herd either. So
Right.
nobody is interested in the market at that point.
Right.
There's a complete lack of interest.
So the volume there is made up of who? Few of the herd and...
Few of the herd, and there's certainly no professional interest in that.
Yeah, it could be a news story. It could be a number of things that happen there that cause the market to go up on very, very low volume. But it's the volume we're interested in. There's no real activity on that bar, and therefore, if you make a decision to buy on that bar on that volume, you would be very, very risky to go long on that.
Very
in
much
fact,
so.
it would be stupid.
Yes, yes.
Okay, Tom, no demand at market tops. Do you just want to explain that one?
Well, it's no demand at market tops. If you go in hindsight and look through your charts and look at these markets where they obviously have become weak and they're obviously in a downtrend, look at all the times that you get no demand up bars, and you see that weak markets are riddled with no demand up bars. But strong markets aren't necessary, but the weak markets are. And that's because every time the market's marked up, probably marked up by the market maker specialist, the professional money says, well, that's fine, but we're not interested. And that accounts for the low volume,
Now,
low activity.
Scott says no demand does not mean selling, though. It's not selling, it just means no buying.
Yeah.
I would actually say no demand generally is not a sell signal in its own right. It needs weakness in the background. It's a confirming signal.
That's true.
Right.
So you
say that again. That's important.
No demand is a confirming signal. You need to have something behind it for it to have any importance. And it's that weakness behind it that brings the no demand to life.
Yeah. Now, interestingly, we're just looking at the Apple chart, and I can tell you that this was taken. The actual chart was taken a few days ago here. So one of the things that we're going to need to look for now is we're approaching an old top on Apple. So if you want to go and follow this through next week, you can do to see what they do here, because the next bar has closed level with that little no demand bar. So if that's genuine no demand, you'd expect the price to fall. And Brad is saying here from Australia, no demand on low volume is lack of commitment to the upside. That's a good description. Lack of commitment from professionals to take the price higher, so they withdraw their interest. Now, Tom, you said we see no demand bars all over the place. Well, if we look at this chart of Apple here, we look at this bar here, for instance, and we can see it's volume less than the previous two bars, but the next bar closes higher. Now, a lot of traders who start with VSA, they read the book and they say, oh, look, there's no demand. It's a very simple thing to see. It's a narrow spread up bar, volume less than the previous two bars, it's no demand. Now, the problem is, when they're in an uptrend or a strong uptrend, they often think they found the top of the market. And so they try and short it, it goes down one bar and shoots up and kills them. So let's get this very clear in this seminar. You only short no demand when you have serious weakness somewhere behind you, like a buying climax, a end of a rising market, something that's serious enough, even a high volume upthrust followed by no demand.
That's right.
Now, let me just, again,
That's
Tom,
right.
we always talk about the background, okay, and most traders will look in isolation at the right edge, and here in Apple, they may well see the market climbing, and a red signal will appear in the program, okay, and it will say no demand. And it's in an uptrend, and you might have strength behind you. And indeed, the market may fall for 2 or 3 days, but because of the strength in the background, it then suddenly shoots up, and they've shorted on no demand. Could we give a very simple rule here and now, Philip and Tom, that we say from this masterclass, do not short no demand in an uptrend. The best place to short no demand is in a downtrend with immediate weakness or distant weakness, as long as it's powerful. Would you agree?
I'd go further than that, and I'd say you must not short no demand unless you have weakness in the background.
Which we're going to show you in a minute, by the way, so don't worry.
There must be weakness in the background.
Yeah, that's very, very important. I agree.
So, or obviously in a downtrend, which implies that there is weakness in the background.
Yeah. So here we've got this. This is Apple now, so you can watch this next week, but you don't rush out and short this because the trend is still up. And the weekly, this is a weekly chart of Apple Computer. It's still a very, very strong uptrend in place. What I'd want to see now is a serious sign of weakness. Now we do have something on this bar here, Philip, which is a very high volume, widespread down bar, and it's going back up on low volume. Do you now this is a chart that we can all follow next week, next Saturday, to see what happens, because I took this chart yesterday. Would you make anything of that? Is there anything that would concern you, that widespread down bar like that? Is that serious weakness, or is this just a little bit of profit taking potentially?
Well, there is obviously some weakness in there, because that bar has gone up and collapsed down, closed on the low. So there must be some supply or selling coming in on that bar. Mm-hmm. But the other thing is that subsequent to that, the market has gone up the next bar. So there must have been some buying in there as well. Mm-hmm. And the problem we have is trying to identify the amount of buying and the amount of selling that's in there. Now, and the easiest thing there is to look into the last 3 or 4 bars. And it does look as if you've got some weakness coming in.
Yeah, and Erica has correctly identified. She says, look, there must be some weakness on this bar here. Would you agree?
Absolutely.
Because
that's the start. That's preliminary distribution, or the start of the selling.
Yeah, well spotted, Erica. That's exactly what we wanted you to see. Here, on this chart of Apple, we've got a very widespread up look, closing off the high. The next bar closes low. And it just drifts up to here on pretty low volume. And it moves the market sideways before we have another effort to rise. But it's not really strong effort because there's no volume there. And then it's marked back down. Now, this is a stock you can all follow. This is why we've chosen it. So you can all follow this particular stock, and you can actually see if this does the mushroom. Now, because it's a weekly chart, this may take several weeks to appear. What we're looking for, if it's genuine distribution, which I certainly believe it to be, and this is genuine weakness, we would take out the low of the distribution bar here. So mark that low. I think that's around the middle of October of 2009. Wait to penetrate that, so we have the rolling over that I showed you earlier. And if it goes back up there on a no demand bar like this, then you have your shorting opportunity, or you have a potential put option on Apple. Philip, would you agree with that?
Totally.
Yeah.
Totally agree.
Yeah, exactly. Okay. If we all see an upthrust at that level, I think you're talking about at this area here, so they bring it down and put an upthrust in. Is that also potentially a shorting opportunity? I would shorten up thrust if the volume was high enough, especially with the weakness in the background.
Yes.
Would you agree with that?
Yes,
Tom?
because that would confirm it.
Yes, I would. But I had a look at the S&P 500 only this morning, and it does look as if that market wants to go up next week. So I'd be very, very careful, because Apple is acting as strong as the index. It's almost the market leader, and if the index goes up, that's going to go up. So I'd be pretty cautious here.
But I want you to look at the chart we have up now. Now, I first of all want you to notice the actual signal at the top there, that narrow spread gap up bar on very low volume. No demand, market top. Okay, we're at that very same price level right now. Okay, so I've gone back to 2007 in December, where the price came up there and immediately was rejected. It's never gone up there since until now. So we are at an important price level. Now, if this is serious weakness, we are going to see this market start to fall off. But if the parent index it's in continues to climb, this stock will not fall. It may move sideways on the weakness, but always look at the parent first before you look at the stock, and I'd even recommend looking at the sector as well. Now, Philip, you're an expert at this. Could you just explain that, how you use sectors and then you use the parent to, I mean, there's other traders in it besides stock traders, but this is quite important.
Well, you've got three charts there you can look at. The first one is the parent index. So if we're talking about the American markets, we'd look at the S&P 500 index. If you're considering, for example, Apple, I don't know the American sectors very well, so I don't know what sectors are in, but let's say it's in the technology sector. Mm-hmm. You would then look at the technology sector index.
Yep.
And see whether the technology sector index is performing stronger or weaker than the S&P 500. If it's performing stronger, then that's a good sector to be in. Mm-hmm. And having picked the sector, you then want to look at the strongest stocks within that sector. So the stocks which are performing best within the sector itself. That way you should get the strongest performing stocks in the index.
Philip, this is a stock you selected. It's Aviva. It's a UK stock on the FTSE. Okay, the FTSE 100, correct?
Yes.
You've seen a very clear example here. Well, there's several principles here. Do you just want to talk us through ABC and what the principles are?
Well, we've been in an uptrend, a short-term uptrend, But we're coming up to an old high, which Gavin has marked at roughly 418 pence. At A, you've got an up bar. It's closed down near the lows, up at that previous resistance level. You've got quite high volume. In fact, there's ultra high volume there. The following bar, bar B, look at the volume at the bottom. It's coloured pink. That's actually very clear no demand. It's an up bar with a narrow spread. It's closed just below the middle, and the volume has dropped off considerably. So that confirms the weakness on bar A. And then bar C, we've actually got close, I think there's a down bar, isn't it, Gavin?
Slightly down, yeah,
Slightly
by
down,
about a
yes.
penny.
Yes, so that does actually confirm the weakness. And then finally, the bar after that pushes down and locks in traders into poor positions.
Yeah, this bar here.
Yes.
Okay. So again, we see that if we see that 4-bar setup at a market top, it's a strong indication of weakness.
Yes.
And that again, we're teaching you today. Whether you, we like to teach you in the VSA Club how to look very closely at trends and trading in harmony with the trend. But there are times, from a VSA perspective, where you will be able to identify, okay, very strong signs of weakness and strength, and actually find the market top and bottom, which is, I suppose, Tom, the holy grail for many traders using technical analysis who are using past price. Now, what was interesting was in New York, some gentleman came up to me afterwards. He said, I used TradeStation and I used an optimized system that I brought. He'd paid $10,000 for it. And on JP Morgan had given him a strong buy signal based on a moving average and a stochastic, which I don't use, as you know. And now, Tom, those are based on past price. And of course, if you looked at the past price, it sensibly would have said to you, it's been rising, the moving average was up, everything's a buy. And yet we don't use mathematical formulas in what we teach. Why?
Well, over the years, I mean, there's always improvements going on everything around us. Technology, TV sets are improving. They've gone digital. I've seen so many improvements over the last 20 years on various things. So why shouldn't technical analysis as such improve? And I think you'll find that what we teach you is in fact the truth and is the next step up. These formulas, I've got a feeling in the back of my mind that some of them look pretty good when you look back in hindsight. And I think the reason for that is that they're simply not traded enough. If people out there know there's something definitely going to happen with simple mathematical formula, the very fact is they know it's going to happen, they will trade that out of existence before it even appears. And that's why I feel that they're there, because people don't, they're not reliable enough to trade. I may be wrong, but I think I'm right along those lines. But what we remember that with mathematical formulas, you're relying on a formula that tells the market, right, now's the time you should be moving up, now's the time you should be moving down, according to past history. But we don't do that. We let the market tell us what it wants to do. And I think you'll find we're head and shoulders above any other technical system. We let the market tell us. When you see a successful test, the market's saying, yes, I want to go up. If you see an upthrust after weakness, the market says, yes, I'm weak, I'm going off, down. And that's what we wait for. We let the market tell us what it wants to do.
Yeah, no, that makes sense. Now, Philip, question came in here quickly. Morris said, bar C is a bit confusing on this chart. Now, bar C, which is that one there that we're pointing at, says it looks like it's trying to hold the market up after the no demand, but it does actually close lower, bar C does, but it comes down and closes up on the high here. Why is that bar a weak bar with the no demand? Is it because no demand and the upthrust behind it makes it a weak bar?
It's the two bars behind it which potentially make it weak. It's actually a test with fairly high volume. It's too high a volume really to be a test, and it's a test that's in the wrong place. That's the important thing, because you've got two signs of weakness behind you, not just one but two.
So you wouldn't have entered a trade short there. You'd have waited for at least the following bar, which was the markdown bar, and then maybe waited for something like an up thrust, something like that, just here.
Yes.
Yeah.
Yes.
So maybe if you want to enter there, because this does, you know, it's a principle and it's here. I mean, it's absolutely correct. It's at the right place. This bar here, the one you were talking about, Morris, number C, is a bar that, from a VSE perspective, doesn't mean anything in context at that moment. Correct, Philip?
That's right.
So you almost disregard it and say, okay, well, I know I've got two weak bars in A and B.
Yes.
C is closed lower. That does mean something to me. It's closed lower than B, which is no demand. So because I've seen a lower close, I want to now, it wasn't enough of a lower close to give me real confirmation. Wait for the next bar, which is a real low close. And that really gives you the 4-bar confirmation there. And the market plummets. You agree?
Yes.
Perfect. All right, let's summarise. Shorting after no demand at a market top. Wait for the market to roll over. Okay. Remember, you do not know if this is the actual top until we see a change in the trend, as we just showed you. So Philip probably would have waited for it to come off and go back up on an up thrust or no demand, which I would do. Do not go short on no demand bars like this if there is an uptrend still in place. Be patient. These bars are far more powerful places to short when you have a serious sign of weakness in the background. Now, we've repeated that how many times, Philip? 1, 2, 3. Let's just repeat it again.
Really,
no demand
really
entry
important.
short. The best place, weakness in the background, end of a rising market, something serious.
The only
Ultra high
place.
volume up, but it's the only place,
Yes.
really. Yeah, let me repeat, the only place. Would you agree with that, Tom? The only place to short no demand to be
That's
safe.
true. It is the only place.
A low risk entry is when you've got
And it's
weakness.
no good looking and say, oh, look, there's no demand here. And right behind you've got test and signs of stopping volume and everything in the past few bars. No demand comes in after you've seen serious signs of weakness. Professional money sees it very, very clearly. And when it's marked up, probably in the cash market, then they're not participating. That's why it's low volume.
Yeah, I mean, and Erica said, is that a hidden up thrust, Philip? Just here, just after the 2-3 bars? It certainly could be. This one here. It closes up near here and it closes down on the low. It's not
Probably not quite
perfect,
an
is
up
it?
thrust. No.
No, but we'll talk about up thrust in a second, Erica, because there are specific examples. I think you meant after C, the one that was after
Yes,
C there.
yes.
But no, I think you get better examples of up thrust. Absolutely. Chris makes a good point here, actually. Now, when you see no demand, you definitely see no demand bars appearing after you've got accumulation going on, and they move the price up, and it goes up on low volume because they want the price to come down. It's not an ideal place to short,
Definitely
but
not.
you do see it. I mean, and that's a very good point, Chris. Well done, and we'll talk about that when we get to the chart. No demand to short it has to be, and we'll repeat it again, weakness. But you do see strong signs of strength. The market goes up on no demand and comes back down just a little bit, because professionals have to buy more at that lower price again.
They're hesitating.
Yeah, well, we'll show that when we get to the signs of strength. Okay, good.